All right. Welcome to 2022. Welcome to live Q&A with Matt the Mortgage Guy. I'm excited. I hope you're excited. New camera. Who dis? I think I'm not a tech genius, but I was messing with a few settings. It should be kind of dialed in. I know the videos I do probably next week or the week after. Once all the ones that I've done so far on my iPhone get edited and pushed out, then we'll have some new videos. New crisp, clear Sony A7C type quality videos coming out. Special shout out to my buddy Kyle Seagraves from Win the House You Love, my buddy Jeb Smith down south, my buddy Mark McDonough in Sacramento. Anybody and everybody who's got more knowledge than me when it comes to tech and video and cameras for letting me know what I should be getting to just up the quality just a little bit, right? I'm not a fancy dude. I think most people that follow this know that, but it doesn't hurt to have a little crispier. I think the kids use the word crispy. So the video is going to be crispier in 2022, and hopefully that helps engage more people to become financially literate, educated around mortgage, and things that can help them win in 2022. So if you haven't been paying attention, today was a pretty nasty day. When it comes to interest rates, and any day like today where we lose 50 basis points in simple terms, rates got about an eighth worse. It can be devastating for some people, right? People that are looking at rates every single day, mortgage brokers, especially like my buddy Eric Tepley over there in the comments. Like it's like the sky is falling. But when you step back and look at it for a second and you're thinking about purchasing a house in 2022, I can promise you that 5 years ago, 10 years ago, 20 years ago, someone offers you a 3.3% 30-year fixed, you're going to take it. It's a good looking loan, right? And, like we've said time and time again, I probably am tired of hearing myself say it. Like rates are headed up. We know that, right? And I'll get into it in more detail if my buddy Eric Tepp wants me to elaborate, right? Like what's going to happen with rates in 2022. They're going up. I don't know if you caught it, Mr. Tepley, but you're right. Your follow-up comment. If anybody doesn't know Eric Tepley's high quality loan originator for 2 decades. The guy is older than dirt, been doing mortgage for a long time, a lot longer than I have. For the first half of the year, we see rates increasing. We see the Fed slowing their purchase of mortgage-backed securities. That means rates go up. And then once they're done with that, then they can actually tick up the Fed's funds rate, whether that's 1, 2, 3 tick ups. Like that's going to mean higher interest rates if they can tame inflation. Some smart dudes out there, Barry Habib, being the one that I'm listening to, thinks that we might see some reprieve. We might see rates going down towards the end of 2022. So get ready for that video. I'm going to shoot that video tomorrow, I think, that talks about what we might see next year. Well, you might see something like that. And I think as much as Barry's been right, Eric, like I'm not going to start disbelieving it now. Maybe we go the first half of the year from where we're at. Like today, I'm looking at mortgagenewsdaily.com. 3.29% on a 30-year fixed is just like, they ask a few people across the nation where rates are at. It's like a rate survey, right? If that goes to 3.75 by the midway point of 2022, and then we get inflation under control and rates come back the other way, they might get back to 3.25 by the end of 2022. Anybody in mortgage will admit to you, I don't have a crystal ball. Tep seems to believe that my buddy Habib might have a crystal ball. But I think that it's, certainly possible that we see something like that, right? We see an uptick for the first 2-ish quarters of 2022, and then we see them coming back down. Who knows? I mean, your guess is as good as mine. Good evening, Basilio. Thanks for joining. Happy New Year. Happy New Year to everybody who's joining tonight. I really appreciate whether it's on Facebook, whether it's on YouTube, Appreciate the support. I love the questions. A quick heads up. Next week, I've got my buddy Jimmy Hobson from the Utah branch of U Mortgage. The guy is an absolute VA expert. He's in a group, vetted VA, that really takes a lot of pride in knowing VA front and back. We write VA loans. We do plenty of VA loans in my office. I think that I know about VA. Then I talk to somebody like Jimmy and I realize like this guy knows minutia. This guy knows every single detail and really takes pride in serving veterans at a super high level. So next week, January 10th, 2022, whether you're catching this live or you're catching this on a replay, if you want to know about VA loans, tune in, ask anything VA related next week, and we'll have the expert on here to answer those questions for you live. We'll get into VA loans, the benefit of VA loans, maybe some pros, some cons, some myths, some things that you might not know about VA loans, because they're really a great loan to a demographic that deserves home ownership as much as anybody, who really, should get the best loan terms out there. Happy New Year, Michelle. Good to see you. Thanks for joining. Who else we got? My buddy Kevin Harrison. What about the mortgage forbearance? That's on a case-by-case basis. Every servicer's handling it different, Kevin. I've talked to plenty of clients, and I tell them like, hey, let me know, give me feedback. What's your servicer saying? How are they handling you exiting forbearance? It's really like, a lot of different options for people. And I've seen all kinds of different stuff where people are able to lower their rate, stretch their term out to 40 years, or they stay in a 30-year, but they're exiting forbearance, and 9 out of 10, maybe 9.5 out of 10 are taking that past due balance and slapping it on to the back of the loan, meaning nothing's due now. When they pay or they refinance, they're going to have to pay off that balance in the future. For anybody who's eligible for a refinance, who has a benefit with a refinance, they're just going forward and doing a refinance and paying that off. So they don't have to worry about 15, 20, 25,000 on the back end of the loan when time comes to refinance, sell, or whatever they're going to do. They just don't want to have that second lien hanging out on there. So I don't think it's really going to have a big market impact, Kevin, because there's just, as people have exited forbearance, there have been kind of waves of exiting forbearance. They've all been entering into, modification agreements. They've been refinancing, they've been exiting, and I don't know what the term for it is now paying, right? There hasn't been a lot of defaults. There hasn't been a lot of issue with that. All right. Tepley is voting for 3.25 or better. But let's clarify, if you missed the beginning of this, we think rates will go up Q1, Q2. And then and this is a big if, right? This is where I think this is going to be the decider, whether or not inflation is under control. If it's not under control, I don't think rates come down. If inflation continues, most of the smartest folks in the room are saying we're going to continue to see inflation numbers tick up January and February, and then inflation will, slow down after that. So if inflation's under control, Q3, Q4, we might see rates swing back, right? We shall see. Have a good night, brother. I appreciate you. I'm going to keep doing it. Just like we talked about 2015, 2016. You're like, what are you doing with this YouTube stuff, man? What's going on? I'm shooting all these videos. More video. People love consuming content via video. I know that 82% of content in 2022 is going to be consumed via video. So I'm going to keep making them, whether folks like it or not. Some people don't like it. That's all right. I'll keep making it. If you enjoy it, if you find value in it, I appreciate it. Smash the like button. How many likes we got here? Does that matter? The likes matter. Does it show it to more people if more people are liking it? Is the YouTube algorithm real? We shall see. Happy New Year, No Codon. Appreciate you joining. Alvaro Vargas. Do you see a $1,350 principal and interest and taxes a fair payment for $4,500 take-home pay? I mean, fair is kind of a silly or like a funny word, right? Like, I mean, I think maybe you mean this as like a reasonable payment, right? And you're comparing take-home pay with with the payment. Really, lenders look at gross pay, which I agree doesn't make any sense. For this specific scenario, rough math in my head, that's about 30% of your take-home pay being your mortgage payment. I think that's reasonable. And I think that if I looked back at data and I looked at all the mortgages we've done, that's probably the average, at least for, first-time home buyers. Maybe when you're 40, 50, you're more established in your career and you're making more money, then your mortgage payment might be 20%, 25% of your income. But certainly the 1350, which is 30%, is reasonable. Where you're going to find you have trouble qualifying is if you have a lot of other debt, right? Because all that other debt, where you take your mortgage plus that debt and you look at your back end ratio, which is mortgage plus all other debt versus your income. And let's just say that 4,500 was your gross pay. You couldn't have total debts in excess of 45% for some loan programs, 50% for other loan programs. Even the most loose of programs, you're going to be capped near that 50% mark. Might go up to 55% on some loan programs, but I'd say that that's reasonable. I think that's what you meant by that word fair. Jason Garcia. This is an interesting question. And what's funny is I've put some thought into this lately, so I'm glad you brought this up. Asking about interest-only loans. Lenders I work with, lenders that I really like a lot, have come out with more of these interest-only products. And I think that it's a double-edged sword. Before I guess go into your question, I just want to let people know an interest-only product is a mortgage where instead of paying principal and interest plus the tax and insurance, you're only paying interest. You're not paying anything towards principal. So your loan balance is not going down over time. What that does is con, you're not paying your loan balance down. Pro, you're paying less per month. And on jumbo loans, like we've got some interest-only jumbo products, it can be huge, right? You could have an interest-only loan of $1 million, and it's $1,000 less per month than the fully amortized payment with principal and interest. And I guess the pro to that is that you're saving money, like Jason's talking about. If you're trying to expand your portfolio, you're trying to add more real estate, collect more cash so that you have down payment for the next one. It can be a positive thing. The con, obviously, is like you own the thing for 5 years. You haven't paid it down at all. You bought it for $1.25 million, and now it's worth 1.4. If you would have had a regular amortized loan, you might only owe $915. You still owe $1 million, right? And so there's that. And really, Jason, like, I think it's personal preference. A lot of really financially sophisticated folks will say, I'll pay towards principal what I want at the time. And they use it kind of as this leverage tool where they're taking that extra 1,000, they've got it invested somewhere else where they're gaining 10%, 12%, 15% cash on cash returns in another investment vehicle. So why in the heck are they trying to pay down this 3.25% interest rate mortgage, right? And so they'll do that. Maybe they'll, get a lump sum of cash from one of these investments that they're invested in and go ahead and throw 100,000 towards principal. But then in the meantime, they're paying only interest, not principal, and using that extra cash flow to go invest in other things, more real estate investment trust, something else like that. Like I see that and I understand why people use that strategy. I just think that that's something that's like that person's personal preference. And I wouldn't want to advise somebody like, hey, you should or shouldn't do this. So I guess in that long-winded explanation, my opinion is that it's personal preference and it's available for people that want to do it. I see it more on the jumbo products than on the conventional loans. So that's that. Happy New Year, Mr. Al Bundy. Good to see you here. I love this question because this is a very common question and people are surprised when they hear it, which they shouldn't be. A refinance does not, let me repeat, a refinance does not have your property taxes reassessed in California. It's not an event where there's change of ownership. The only time you're going to get reassessed from the county and your property tax will go up is when there's a change in ownership. A refinance is not a change of ownership. So you can have your property taxes be whatever they are. You've owned the thing for 25 years and you refinance and you pull out $300,000 in equity. A lot of people are worried about, man, my taxes are going to go up. Your taxes will not go up. You will not be reassessed. I promise you. No Codon. Do you require a maximum deductible for insurance claims? No idea what you're asking. You have to have enough insurance to cover a complete loss. And I think that's what the lender is going to worry about. And that's what I'm considering not escrowing my insurance and having a higher deductible. You can do that. I think there's probably a max deductible, right? Like you can't have a $10,000 deductible. I'd have to double check. I'm going to write notes here to my insurance guy. Max, or maybe I should have to ask an underwriter. Deductible on insurance. That's a very good question. First stumper of the night. I do not know what the max is. Kevin, you shouldn't be reading all that FUD, man. All that fear, uncertainty, and doubt. YouTube is full of market crash. What's that guy? Reventure Capital. I'm going to see if that guy wants to bet me $25,000. I'm going to, like, he's so certain the market's going to crash in every single video. He does 3 a week about the market crashing. If the market, real estate market as a whole goes down 20%, 20% is considered a crash, right? In 2022, I will stroke him a check for $25,000. I'll give him 2-to-1 odds too. If it doesn't, he's only got to write me a check for $12,500. I'm going to hit him up, Reventure Capital, and see if he wants to take the bet. My guess is that he won't. Like a lot of other folks that are market crash 2015, 16, 17, 18, 19, 20, 21, 22. They're doing it to get clicks. They're doing it because it sells, right? If it bleeds, it leads. So you make videos on the market crashing and, you know, even I know that's true, right? If I make a video, Kevin, that says, is the market crashing in 2022? I'm going to give my honest opinion. There's no freaking chance. But that type of stuff, it gets clicks, it gets views. People want it to happen. I would love it. I've got 115 people pre-approved, ready to buy. If the market went down by 20%, it would be sweet. It would be amazing for my investor clients, for my first-time home buyer clients, for me and my wife. We'd be buying property, but it's just not going to happen. Too much demand, not enough inventory, no event that's going to cause a big influx in inventory. So, yeah, these folks are trying to find any reason, right? And they can make a video that says, oh, it's, you know, forbearance is going to end. It's going to cause a lot of foreclosures. I was making videos like end of 2020, beginning of 2021, that was showing as people exited forbearance, they were not defaulting on their loan. Like they were making good. They were selling their house. They were refinancing. They were just exiting. And here was the thing. A ton of people in forbearance were in forbearance and they didn't have true financial hardship. They took it because they could. And truth be told, I didn't blame them, right? It was available. They didn't have to prove anything. So now we're past it. Now, like X percent, a large percentage have exited and we've seen no repercussions, like no foreclosures. The few 100,000 that are left to exit forbearance are not going to cause any foreclosure wave anyhow. Michelle, higher property taxes will apply if you do home improvement with permits. Is this true? This is definitely true. Why is this volume supposed to be off on this and it's still barking at me? Excuse me, phone. So you do home improvements, you pull permits from the county, you are 100% correct. They will come after you for every last penny. I did a 400 square foot addition, 2019-ish. And my wife and I are lucky. It would be a lot more expensive in 20 and 21. We did it in 2019, but the county assessor's office gets that permit information about what's been added. And they send you a tax bill, supplemental tax bill, and they jack you up. So it'll certainly impact your taxes. And in California, where I'm at, they're going after them property taxes for sure. Know thyself first. At what calculation is it worth paying for points in your cash out refinance if you're going to use that cash to invest in another property? I mean, the whole points conversation, I think, is really a math one. And if the break even is more than 36 or 48 months, I don't think it's ever worth it. Even if you're like, listen, Matt, I'm keeping this thing for the next 10 years for sure. Imagine that you paid $4,800 in points and it saved you $100 a month. Well, that's the math you want to do, right? You just got to remember you're spending today's dollars. Like $2020 versus $2021, we're only worth 93 cents on the dollar. So if you spend $4,800 today and you save $100 a month, but the 100 you save 4 years from now is only really worth 85. You got to take that into consideration, right? There's usually a sweet spot. And this is something that I would talk with your mortgage broker about is, there's a law of diminishing returns. Lenders, when you see the whole rate sheet, they're kind of like pointing you towards a certain rate where if you go an eighth lower, it's going to cost you a lot to move a little, an eighth, right? And there's usually, like right now on a lot of rate sheets I'm seeing, 3.125, 3.25, and 3.375 are the rates where lenders are making it worthwhile, where you pick any of those and you'd be fine. If you want to go to 299, if you want to go to 2875, it's just expensive. And so you gotta do the math and you gotta think about like the future value of money. I'm not recommending it. And like we talked about earlier in the live, if rates go down the end of 2022, let's say that you paid $6,500 to go to a 3.25, and the end of 2022, inflation, disappears, rates come down to 2.99. You're not going to refinance 299 because you're going to have paid $6,500 for that 3.25. If you go 3.375 or 3.5, you don't pay anything for it, then maybe that refinance makes sense. I don't know. You don't think he would touch that bet? Well, why does he keep preaching then? That'd be fun to do like a live with my boy from Reventure. But you're right, he wouldn't do it. It's just it gets clicks, right? So make the videos that get the clicks, get the views, and talk about a market crash and look at this data over here and these. You can make anything sound believable, I think, if you got put enough passion behind it. Yeah, this is something that is really one of the main reasons, I think, Michelle, why the market or why forbearance didn't have a big of an impact or really any impact at all is because in most markets between 2019 and 2021, there was 30% price appreciation. So if you had a house that you bought for 300 and you owed 280 and you took forbearance for 18 months, it's worth 390 or 400,000 now. So you certainly wouldn't go into foreclosure, even if you owe 280 plus 18 months worth of payments, right? You owe 300, but it's worth 400. You ain't letting that thing go. So yeah, folks are holding on tight. Another doom and gloomer. Scott Walters, a realtor in is SB Santa Barbara. Yeah, he talks about doom and gloom, but he's only sold a couple mobile homes. So I don't know how good his info is, but I mean, if he can't make it in real estate, maybe he can make it in YouTube videos. He's just got to make the crash videos because those are the ones that get the most views. It's a lot easier to do that than talk about really good info and grow organically over time over 7 years, like your boy MTMG. Fun fact, 7 years of videos every single week. Luis Harcia, random question. Do I know any developers in San Diego working with 20 acres? You want to make it into a mobile home park? I don't. I actually know some investors and realtors that do like single home flips. Somebody that just did a nice one in San Diego. I wish I could buy it, but it's going to be like $3.5 million for a beachfront place down there. 20 acres, making it a mobile home park. Who knows where you would even find somebody like that? I would not know. Contact Brandon Turner. Maybe he knows. You know what? No code on. There's zero evidence of it, and there's really a lot of like data support that like the real estate market is healthy and will not decline anytime soon. Here's my guess. Some people don't even believe that the sky is falling. They just know if they make those videos, they'll get views, right? So they'll continue to make those videos. I guess to each their own. If that's what they got to do, then that's what they got to do. Know thyself first. How do jumbo rates move compared to regular loans, in tandem or differently? They're generally going to be moving, similar. A lot of jumbo loan lenders, the jumbo product is like almost like a portfolio or in-house product where it's not necessarily going to follow Fannie and Freddie, but those have moved up along with conventional loans. And man, I looked at, what moved up a ton and what will move in tandem is different lenders that have a similar product. As one moves up, whatever they're looking at to base risk on, I think they're looking at the same stuff. A specific product that I saw go up even more than conventional loans over this past 4-week period is 10% down jumbo. 10% down jumbo, there was a lot of lenders who jumped into this probably mid 2021. The biggest lender of them all rolled out a product in March of 2021. And then I saw a lot of people follow. I tried to price some of those and holy moly, like across the board, it's probably gone up a full % over the last I don't know, 2 or 3 months. Apparently, 10% down jumbo loans are risky. I knew that. And so they're all adjusting rates for that extra risk, right? A freeze in price for half a decade? I wouldn't bank on that either, right? It's one of those things where, like, people like real estate prices have to cool off. Like, says who? Rent prices have to cool off. Gas prices have to cool off. Bacon should be less expensive. All of it. If we were just saying that things should be cheaper, because that would be more convenient for folks, but I don't think so. I think that, like, all the money printing that's gone on over the past 2 years, a lot of this inflationary pressure is here to stay. And I don't think that, like, all the data, all the underbuilding, like, that's another thing to think about, right? We have underbuilt for like a decade. And so, I don't see a prolonged period of real estate prices flattening. But what do I know? All right, you got the land under contract. What does it cost for 20 acres in San Diego? It's got to be pretty penny. But yeah, I would maybe talk to some folks who have some experience in the mobile home park space and do some sort of joint venture, right? If they've got all the know-how, you've got the land, maybe they can provide some of the capital, some of the know-how, and you can run the project. Be fun. Lorenzo Campbell, thanks for joining. Appreciate you. Happy New Year. VA guidelines allow for joint VA financing with 2 or more veterans for 5 residential units. I think it was on here last week. Bring this up next week, because next week we're going to have Jimmy Hobson, the VA expert, on. I've never heard of this. And so I've certainly never heard of anyone who got a loan like this with 5 residential units and 1 commercial, but Jimmy would probably know. It sounds like pretty far-fetched. Sounds like a tall tale to me, but who knows? You think we got all the appreciation the first half of this decade? Maybe. I mean, a couple years of some 1-2% appreciation would be good for a lot of people. A lot of the buyers that have pre-approved, for sure. Investors I know might be a little bit sad, right? You own 3, 4, 5 million in real estate. It's nice to watch it go up 5, 6, 8, 10% a year. Just hundreds of thousands of being added to the net worth in your sleep. That's good, but who knows? The 10-year Treasury today, on a side note, up 13 basis points to 162. I'm going to show you guys something here. This is a nasty chart. We alluded to it earlier. Let's show this screen. There we go. So these red candles means rates worse. And up here, this is near my birthday, beginning of August. Rates were much, much better. 104.33. And then September, October, November, December, January, 5-month period. It's like steady down, which means mortgage rates higher. This red candle right here is like pretty nasty. For, like, you see all the volatility in every day, up and down, up and down, up and down. But like a big 52 basis point candle like today, That's nasty. We'll see. We'll see if we get any sort of rebound tomorrow. 3.3 is like the 30-year fixed average based on that Mortgage News Daily survey. Sure, you can pay points to get it lower. Sure, you might be able to find it cheaper with a mortgage broker, but that's just an average. Yeah, that chart showing 50 basis points, know thyself first, is about an eighth, right? Let me see. I think on Mortgage News Daily you can see like the daily trends. That's kind of crazy. Like it's showing that on the last Wednesday, Thursday, Friday was 326, 327, and 32, and like today's 329. It's hard to believe that it's only that slight of an uptick on their daily survey, right? I think that lenders probably adjusted a little bit more than 2 or 3 basis points in rate. We'll see. I'm guessing we get a little bit of a pullback tomorrow. I hope. Who knows? I've been telling people for a long time, though, if you like it, lock it. And I've probably got, I don't know, dozens of people thinking about refinance. I don't know. It might take some cash out. I might not. Like people that are waiting are getting punched in the stomach. Marvin Viscata, thanks for joining. Does it matter when you pay a lump sum towards your mortgage principal? Someone told me if I could pay the day the mortgage is due or the first day of January is better. Is that true? Sounds like some more bad advice from a drunk uncle. You pay extra towards your mortgage principal. It doesn't matter what day you pay it. You're going to pay down that principal. Like you pay it the same day it's due, then the 1,000 you pay or the 5,000 you pay goes all towards principal, and your original payment goes some towards principal, some towards interest. If you pay it 10 days after it's due, then you pay 10 days of interest, and then the rest goes towards principal, which sounds worse, but then your next payment is due, and you've only got 20 days of interest accrued versus 30. So it's all going to wash, right? Anybody who thinks there's some magic potion on like, oh, you got to do it this way. God forbid you listen to these folks that have this system with a home equity line where you pull from the home equity line and you make a principal payment and then you pay off the home equity line, then you do all your bills through the home equity line. I made a video on that. I think that's the one that got like 100,000 views because I was like, just stop all that nonsense. It's really, when you do math, not much better than, hey, I'll make an extra $1,000 a month principal payment, which is the same thing as a $12,000 lump, and then pay off that $12,000 and pay interest on that $12,000. Slight difference, right? Because you pay it all at once versus over 12 payments. But that $37 difference or $82 difference isn't some magical potion that's going to pay off $400,000 overnight. Yes, it makes a difference. So I know I'm going to get old fruit thrown at me because 12,000 today towards principal is better than 1,000 for the next 12 months. Yes, I agree. One, the home equity line is going to have interest as well, right? And that's going to offset what you save. Holy guacamole, I spilled some coffee. But then also, it's not like that's the secret that takes a $400,000 mortgage and has it paid off in a year, right? Like that's what they sell. Anyhow, rant over. Alvaro Vargas. If you don't pull permits and you paint and you remodel your kitchen and you do other stuff, there's no way that the county is going to be like, you know what? We saw a Home Depot box out front of your house. We're pretty sure you did a remodel. Let us in. That's just not going to happen. So I think you're fine. I don't think your property taxes move at all, right? Like, I don't know that I've ever heard of like a spot check by the city or the city being like, hey, we're tapped into Lowe's and we see 3,200 in receipts. We're pretty sure you're doing a home remodel. Enclosed, find your new property tax bill for $5,700 per year versus the $4,000 you're currently paying. It's just not going to happen, right? If a permit is pulled and you do work that requires a permit, that is going to certainly be something that's going to like a reassessment. You're going to pay more property taxes, but you paint your bathroom, you put in a new vanity, you put in a new sink in your kitchen, and you do a built-in hutch and new floors. Like, no, that's not going to be anything that the city is going to have on their radar and then roll by for someone to check that out and then reassess you. Jason Garcia, I appreciate you, man. I guess I've been interacting with humans for 41 years, so I got some of the skills. I appreciate that. And I think that, it's fun. I think it's a good way for people to learn, not just because I'm anything special, but anybody in my position as a mortgage broker who's in it all day, every day. You've seen a thing or two, so you know a thing or two. And we're talking on January 3rd, 2022 about information that's relevant and up to date as of now versus I do a random YouTube search. I ask a question about something. I get results from 2018. I get results from 2016. And it may or may not be relevant, right? Especially in mortgage. Guidelines change all the time. So having this stuff live is something that's definitely value to the consumer, I believe. That's why I keep doing it. Not sure if I'm a land guy. I'm not really a land guy. And, in the lending world, mortgage brokers, direct lenders, my type of 1 to 4 unit residential guy, we're not doing land loans. I've always referred those to US Bank. Out here in California, that's a lender who's really gone out and said, hey, we want to do land loans. So I wouldn't know much about that, about the process. The only thing I can tell you is that buying land is going to be, it's going to require a bigger down payment. Let me see if I could pull this up. I had an email from my US Bank folks with kind of like a cheat sheet on land loans. Let me see if I can pull it up. Then I'm going to provide you some real useful information if that's what you're into. Land loans. Nope. I'll find it. It was, I guess it was in here from more than 2 weeks ago. I thought if I search land loans in my emails, I'd be able to find it. Can't find it. Anyhow, feel free to ping me, matt@mtmg.com. I will gladly send you over like what I know about land loans, down payment requirements, credit score requirements. Some of them have like, max acreage and things like that. But you're going to have to do that. And then dividing it into smaller plots. That's going to be, city, county, state specific on how easy or how hard they make that. Doing a lot of things in California is generally hard because, never mind. I was going to say something sarcastic and mean, but I don't want to talk bad about California. I love the weather. I love the people. I don't agree with some of the tax some of the government policies, but we'll keep this channel mortgage focused. We're not going to talk about any of that stuff. Matt@mtmg.com. Shoot me an email. I'll get you some information on land loans. And then depending on what your state you're in, if you're in California, I would just look up the closest U.S. bank. If you're outside of California, might be somebody else that specializes in land loans where you're at. Michelle Martin, thank you for joining. Appreciate you. Higher interest rates, end of pandemic stimulus payments, end of eviction moratoriums, 7% unemployment, largest increase in CPI in 40 years, end of forbearance on student loan payments in May versus California low housing supply. Yeah, I mean, a lot of stuff going on there. I think that for a simple guy like me, like all this data is great. End of forbearance on student loan payments, end of forbearance on mortgage, all of that stuff, I truly believe is going to have less of an impact than people think. Partly because, you know, the demographic that's buying houses, I think we already saw like a big decrease in first-time home buyer activity, right? Which didn't really have an effect on the market. If first-time home buyers make up 22% of the market and it goes down to 19%, you know, some of these first-time home buyers might be straddled with student loan debt, and that's the reason, right? There still is a lot of demand. And like when supply and demand are as out of balance as they are right now, it's going to take monumentous things to happen. It's going to take like hundreds of thousands of units being built, millions of units being built. And there's just like not enough building going on to satisfy the demand. When you look at the demographics of like 34 to 36, which is like the biggest demographic of home buyers, all you got to do is look at birth rates from 88, 89, and 90, and the people that are turning 34 through 36 over these next few years. Like it's like this. Like more and more of those people are turning that age where they're going to be home buyers, right? And so that, along with the fact that like there's just limited supply. Another thing to take into account is if rates go up and rates even go to like 3.75, everybody who's got a 2.75 is going to be disincentivized to move. And so we've already seen the slowing of turnover, meaning like if somebody used to stay in a house for only 7 or 8 years, and then that would turn over, and this creates new supply. For the first time in a long time, it's over a decade. People are staying in the same house for over a decade. That's only going to continue when somebody's sitting in a $600,000 house with a 2.75% interest rate. They call our team and say, hey, what would it look like if I sold this house and bought for 800? And we go, okay, you want a slightly bigger house or a slightly better neighborhood. You know, you want to sell the 600 and buy 800. Here's what it would look like. And they go, oh man, 3.75% interest rate. They're borrowing a little bit more and they're buying for a little bit higher, but also they're buying it with a 1% higher interest rate. That disincentivizes those folks from moving. So more people stay put, in my opinion, when rates rise. When more people stay put, less supply, like that, like compounds the problem, right? And so most smart people I talk to think that, you know, there's going to be less movement in 2022. That's one of the reasons why. So it's going to be just as competitive, right? And like, so that's going to counteract whatever negative effect, like less people qualifying because of higher rates, because of any of these, you know, forbearance things that are ending and people have like student loan payments to make, or that eats into their ability to save for a down payment or whatnot. Yeah, that inflation number of 6.8% is wild. The crazy part is like when you look at it and you look at its effect on housing, like real assets increase in price in an inflationary period. Real estate is one of them. Rents also increase, and we've seen that. A lot of people that are predicting 5, 6, 8% home price appreciation in 2022. The numbers are going to be fairly similar for rent increases. So it's not getting easier for buyers. It's not getting easier for renters, unfortunately. Hopefully, that answered it. There's a lot of stuff in there. Thanks for that question. That was good. All right. Hello, Matt. Would I still be able to get a 3.5 conventional? I recently refied to VA to conventional with 80% loan to value. For sure. If it's your primary residence and you have decent credit, if you go to Mortgage News Daily, I like it because it's a fairly easy one, and it's, this is one I point people to because mortgage rates are super specific. Credit score, your loan to value, the type of loan, conventional, VA, FHA, all that other stuff. But just for a general idea of what rates will look like, I'll show you how you can just go to mortgagenewsdaily.com. I'm not affiliated with the site in any way. It's just easy. So I just point people to it. They changed their site. This looks different in 2022 than it did last year. Just scroll down a little bit, and right here under here, 30-year fixed rate. Boom. 3.29. And even will show you when you click on it, 30, 15, 30-year FHA. That seems high. It's not that high. Jumbo, 5/1 ARM. The 5/1 ARM is 3.6. Well, maybe you don't want to rely on this data for all of it, but at least the 30-year fixed, that 3.29 is fairly accurate for a rough idea of where rates are at. You know what else you can do? Let's see if we can find it. NML or CFPB rate checker. This is a good one. The CFPB, which is the Consumer Financial Protection Bureau, helps so that people don't be getting ripped off. See if I can find it. They have this rate checker where you can go in there and say, I'm in California. My credit score is 760. I'm putting this down. It's going to tell you this many people are getting 3.25. This many people are getting 3.375. This many people are getting 3.5. It'll tell you where most of the loans are being written for that specific scenario that you type in. Rate checker. Come on. I'll find it. I'll post it in the links. I promise you there is a rate checker on the CFPB's website. I'm going to find it. Don't you guys worry. I know where to look. I'm looking offline here. We'll get back to that. Stay tuned. Alvaro Vargas. You know what? I don't recall. My guess is, my house went from 1,600 square feet to 2,000. So it's whatever that is, a 25% increase in the size. I don't know. My property tax didn't go up by 25%. They probably went from 4,500 to 5,500, if I were to guess. I'd have to look it up. But yeah, they're gonna do their calculations and say, based on land value, the value of the property, what they think that new value is, and then tax you accordingly, right? With 2,000 square feet versus 1,600 is going to be more. Probably went up $1,000, which was roughly 20 to 25% increase. Tamara, this is a good question. I just saw a stat today that said January is the most busy month for divorce. And I guess it's because people like wait until the first of the year to actually file or take care of that, which they've been putting off for a while, after the stress of the holidays subsides. This, I think, Tamara, depends on what state you're in. If you're in a community property state like California, and you're separated but not divorced, you don't have that divorce decree and separation agreement already done and in place, anything you do with that mortgage is going to have to be signed off by your spouse. And so I would check with probably an attorney, but just know that if you're in a community property state, I'm fairly certain you do have to. If it's not a community property state, then I wouldn't know. I'd defer to somebody and get their input. A super sticker from Monty. Thanks. I appreciate that. Super stickers always welcome. Oh, Mark, you like that? This is the new camera, man. I think we're set up. We got lighting, we got camera. These new videos are going to be, I think the young kids at UMortgage told me crispy. That's the word the new kids are using these days. Crispy. Appreciate you, brother. Thanks for your help. Thanks, Michelle. Appreciate you and Ryan over there. All right, Monty Taylor. Which yield should I watch? The 30-year or the 10-year Treasury? Watch the 10-year Treasury. That's the one that more closely correlates with long-term mortgage interest rates. As the 10-year Treasury increases, so do mortgage rates. We saw today the 10-year Treasury went from 149 to 162, and rates took a beating. Taking a beating is like, going from 3.25 to 3.3, which for all intents and purposes, rates are still amazing. So people should not be stressed about it. What time are rates released? When the market is open and mortgage-backed securities are being traded and the 10-year Treasury is moving, rates are moving constantly. In my world, in mortgage, rates can change 3 or 4 times per day. They're literally, got a certain price when they open. We can get a reprice for the worse. We can get a reprice for the better. They close, and the next day they open, and it's at a brand new price, right? So rates are really, really fluid. There's not like, hey, this week we're going to offer 3.25. Next week we might offer 3.375. It's literally daily and multiple times per day when rates are changing. That is something that is a common question. So I'm glad that we got to bring it up. Rates change every day. Rates can change multiple times per day. Just because you saw something Monday at 10:52 a.m. doesn't mean that Thursday afternoon the rates are the same. You'd be surprised. People reach out in early January and say, remember when we talked on September 14th? Let's do that 2.875. And I've got to tell them it's not September 14th anymore. I hate to break it to you. It's January 3rd. Rates have changed. So, multiple times per day. Our first home loan was a VA 10% interest in 1990, but on a $100,000 home. Enjoy the lower rate we have. That's wild, especially considering like VA rates have been in the 2s now, right? VA rates are smoking. I think in the early 80s, the house I grew up in, my parents had a 12% first and an 18% second. Paid 81,000, something like that for it, which was a lot. My parents will tell the story of since it was a 12% interest, it was like $1,000 payment. Apparently my dad was making $1,200 a month. So wasn't a lot of room for groceries or G.I. Joes or Cabbage Patch Dolls. I had to share G.I. Joes with my buddy David Crandall. If me and my sister wanted Cabbage Patch Dolls, which were cool in the 80s, my mom had to sew them. Let me tell you, a homemade Cabbage Patch doll, homemade like sewn Cabbage Patch doll was scary AF. Like the thing was ugly. I love you, Mom, but sewing Cabbage Patch dolls was not your specialty. I think my sister still has nightmares. Anyhow, on with the show. Jason Garcia, asset-based loans for LLCs, what variables are relevant? If the cash flow from renting is higher than monthly payment, you get approved for the loan, assuming good credit. Those exist. Basically, it's not even asset-based. The cash flow loan that you're referring to is a debt service coverage ratio loan. We put those on pause for the time being. I think we're gonna be doing the non-QM stuff again on February 1st, but we just had too much growth going on, too much conventional financing going on across the nation, where like we literally had to put that stuff on pause while we got set up with the best lenders in the country to offer non-QM loans, which the debt service coverage ratio loan, debt service means payment, right? So if you've got a payment of $1,550 and this loan in this rental property that you're buying rents for $1,750 a month, then you've got a higher than 1 debt service coverage ratio. Lenders will lend to you. Higher rate, yes. More fees, yes. But you can get a loan as long as you're self-employed, you've got good credit, and you've got a good down payment. Then you're all set. And in that same bucket of non-QM loans, there's going to be 12-month bank statement loans where you're self-employed and you show we've got $14,000 a month in deposits. We don't need to see tax returns. We don't need to see pay stubs. We just want to see the deposits. They're going to use, most of them, a 50% expense ratio, meaning 14,000 in deposits equals 7,000 in monthly income. Whatever that qualifies you for, we use that, right? So feel free to reach out to us on that stuff. Just know that we're not writing those loans in January. And so you might have to wait until we've got everything in place. We just want to make sure that we've got the best products, right? We're trying to streamline everything and provide the best client experience. And for now, we just can't take all the business. The non-QM stuff's going to have to wait. 10% interest rate, Tamara, she was talking about 1990. So don't be confused. Rates are still low. Most any rate, no matter what the type is, you're going to be sub 5%. Non-QM, VA, FHA, conventional. If someone offers you a 10% interest rate, it's private money or hard money for a flip. Hey, Kathy, this is a great question. I made the video within the last couple of weeks talking about all the cash out refinance that's going to happen in 2022. Tons of people that can benefit from it. There's great benefit in doing a cash out refinance the right way. In your scenario, what you're going to want to look at is what your current rate is, what the new rate's going to be, and you don't necessarily want to go from a 2.6 to a 3.375 to pay off debt. If the rate is staying fairly similar and this $48,000 personal line of credit has a 8% interest rate, then it can make sense. Talk to somebody who you like and trust. Get accurate information on what your current mortgage looks like, what the new mortgage is going to look like. And then, with most any cash out refinance where you're paying off other debt, one thing to make sure of is that you don't go and add new debt, right? Because now you've got this freed up cash flow every month where, hey, I used to pay $600 a month on this personal line of credit. I did a cash out refinance. I paid it off. My mortgage payment only went up $150. Now I've got an extra $450 a month to spend. Do something wise with that savings. Don't go out and buy a boat or get yourself into more debt because of it. If your current one is 3.5, you should be able to do a cash out and keep your rate at that or even lower, depending on credit score, depending on loan to value, all that. So give us a jingle. Go to greatmortgagebroker.com. This is super easy. I think we've even revamped it. Greatmortgagebroker.com. One of these days, I do like a live thing where I oh man, I get distracted easily. Where I pop through and show you guys how quick this little form is, right? Greatmortgagebroker.com. And you can click through it. 60 seconds or less. That's what it says. I think it's more like 30. Anyhow, check that out. We're happy to help. Trust me, I'm a mortgage broker. I've heard plenty of stuff. So when you start with may sound silly, I know it's not going to be the silliest thing I've heard this year. And we're only 3 days in. But I want to pay a home all cash. I need like 10,000 left. Does it matter if I put that 10,000 on a credit card? I have like a 40K limit, so I have enough. Is it possible to do that to equal the price? On a cash purchase, you're not going to necessarily have to source where your down payment comes from. You're just going to wire the $50,000 to title. And so, I don't know if I'd recommend doing a cash advance to buy a home. If you've got a good plan to pay off that 10,000, then go for it, right? And I'm guessing that you're maybe in a market where home prices aren't 500,000 and you're just putting together 50, 60 grand to buy a house. I don't think it's that silly. If you've got enough cash and 10,000 is all you need left, just with, maybe the credit card's got 0% for a year. If that's the case, then I would certainly try to make a plan where it's like, hey, I'm going to pay $900 a month and get this thing knocked off in less than a year. Crispy. A new one for me this year too. Those kids. Loft PH. Shoot. I know a lot about Unison equity share. Very popular in California, California-based company. They help some folks purchase, and they've got equity share in the home. What's funny is I actually got something in the mail about, it looks like they're marketing towards homeowners with equity. Like, hey, do you want $100,000 and we'll take 17% equity in your home? True, it's no payments, but the only thing I would look at, right, is they're going to have an equity stake in your home. So if things appreciate, like a lot of the equity stake agreements that I've looked at, because I've dealt with a lot of clients that have this Unison equity share agreement in place. They bought a house for $1 million. Unison put up 100 grand to help them get into it. And then the client put up another 100. They put 20% down. If Unison owns 33% of whatever equity increase happens, 3 years later, the house has gone up 400,000 in value, 130,000 that is owed to Unison. They're sharing in the upside and the downside. It's another one of those things that I guess it's going to be different for different folks. It's either going to be something that works for them or not. But read the fine print. Make sure you understand it. That's I guess my advice on most anything. All right, a 4623 loan costs 2.99. 30-year conventional. That's a new loan. So box D says loan costs 4623. It's not too bad. I wonder how big of a loan amount it is. I'm guessing you got great credit. Before my time, I was around in 1990. What was I doing in 1990? Fourth grade? I was doing big things over at Hubert Bancroft. I was probably playing flag football, riding my bike around with my little buddies, playing some basketball. Good times there. 1990. I think that's what you're referring to. All right. Homemade Cabbage Patch. Yeah, I mean, they did their best. Looking at papers, 60,000 cash out at 299, 4,600 loan costs. Yeah, I mean, if you're were you the one that said your current rate was 3.5? If it is, then you're going down from 3.5. Oh yeah, you're going down from 3.5 to 299. I like that. Going down 0.5%, take that 60 grand and pay off your $48,000 line of credit that's at a higher rate. I think that's a good plan. Holy cow, I didn't realize how many comments are coming in. Let's jam through some of these questions. Jeanette, this is an amazing question. I haven't got a lot of FHA questions because FHA hasn't been that popular of a loan product these last couple of years, but PMI on an FHA loan, and man, this shows you how little FHA I've done. It's the same mortgage insurance factor for everybody. 640 credit score, 770 credit score, 0.85%. So you can take $400,000 loan. This is if you're putting 3.5% down. Take 400,000, times it by 0.00085. Is that right? Gotta make sure I got the right number of zeros. That ain't the right amount of zeros. 400,000 times 0.0085, just 2 zeros. And you get 3,400 annual premium. Divide that by 12, 283 a month. So $400,000 loan. It's going to be 283 a month in mortgage insurance, whether your credit is 640 or 770. If you put a larger down payment, the FHA mortgage insurance goes down to 0.80, slight decrease, right? And so, not necessarily big difference to put a bigger down payment. Conventional is different. Conventional, your mortgage insurance premium changes at different credit score increments and at different down payment increments. 5, 10, 15. It changes on each one of those, and it changes, 640, 680, 720, 760. And so there's a lot of different mortgage insurance premiums when it comes to conventional. With FHA, it's literally 0.85 or 0.8. And I think 0.8 is at 5% or 10%, one of the two. Shows you how little I've done the last couple of years. Is like it's gone out of my head. And in my head is filled a bunch of jumbo and conventional knowledge because they're more popular products over the last couple of years. I said the 10-year Treasury, right? Yeah, the 10-year Treasury and the 30-year. The 10-year Treasury is what you want to watch and follow. That is what more closely aligns with long-term 30-year fixed rate mortgage debt. That 10-year Treasury being at 1.63, ooh-wee. That did its number on, it ended the day at 1.62, I think. Crazy. MBS. Spruce your house for higher appraisals. Maybe. No boat. That's good. Danny Fox, thanks for joining, man. Good to see you. If you have a recent refinance and you're looking to buy a new primary, you should be fine as long as there's enough time has elapsed between the refinance and the purchase. When you sign a loan as your primary residence, like the refinance, you can't go out the next month and buy a new primary. The lender's going to look at you funny and call it mortgage fraud. But even though you intended to live there for 12 months, like the paperwork said, if circumstances change, you've got to move to a new neighborhood for your kiddos. You want to move closer to grandma. You've got a job that you're moving closer to, a host of different things that can be, explained in a letter of explanation. If you move 8 months later, 9 months later, 10 months later to a new primary, most lenders aren't going to have issue with it, right? It's just got to be legitimate, right? You don't want to be doing stuff that's shady in mortgage and in life. Sounds good, Kathy. Yeah, if you want us to take a look too, I mention this all the time. If you've got something from another lender, it sounds like you got a really good deal kind of lined up. Shoot us the loan estimate over to matt@mtmg.com. We're happy to take a look. If you're near the end of a loan process, I'm never going to tell you like jump ship, right? If you're in the initial stages and you've got a loan estimate that looks ugly, if it's from Quicken and they're charging you 2 points, I'm going to save you $5,000, give you a better loan experience. You can thank me later. But yeah, just ping us, matt@mtmg.com. Send us the loan estimate. We'll take a look. Monty is all about that cash flow, baby. Cash out refi on 3 of my rentals, paid off my current home and all personal debt. My passive income slightly dropped. I like it. I don't agree with Dave Ramsey on a lot of stuff, but one thing I do agree with is if, and I say if, because some people, myself included, just don't feel like paying aggressively on mortgage debt is something that I want to do for the time being while I'm still young and building. But if you're going to pay off anything, pay off your primary residence. If the whole world collapsed tomorrow, the economy went to absolute trash, and Monty Taylor was in a position where he had to let go of property, he wants to let go of the leveraged investment property and know that his personal primary home is paid off and he's got no debt, right? Like that is a safety play. That is a peace of mind play. That is a sleep good at night play. I agree with that 100%. Cheers to you, Monty. I applaud you for having that primary paid off. I don't pay off mortgages, but if I were to, it would be the primary. The equity shared mortgage, no, you can go if you want to look at it, Michelle. It's Unison equity share. They basically take your home value, they do a calculation. They're basically buying equity in your home. They've got calculations and they've got like ways to do it, but up to 17.5% of your home's value to cash. So you can live the life you really want. It's not going to be as good as a cash out refinance where you still get to own 100% of your house, right? Like you're essentially selling a portion of your home and its equity to a third party, which one is kind of scary, and two, like I see a lot of these agreements. I guess some people got to do it, but geez Louise, I've seen a lot where Unison got in for 100 and now Unison is owed like $350. when the person sells. So they done good. And I don't know. I don't know if if it's a long-term hold and you're holding it for the long term, like you want all that increased equity upside. Just my 2 cents. I love Unison though. They're good folks. How long ago did you buy, Tamara? Because this is something where you can do an 80. This is the thing. You can do an 80% first, a 10% second, and then 10% down. I've got a product now where you just put the 10% down and avoid PMI. Don't have to bother with the second loan. I'm pricing a lot of these. MI Buster, pretty sweet program. Is there a certain amount of time you have to live in a home with a conventional loan before you rent it out? Your intent is to live in the home for a year. If things change, like they're not going to come and repossess the house because you've rented it after 9 months. I guess it all depends. The renting out your primary, if you left it, is not really the issue. Where the lender is going to find issue is you trying to get another loan for a new primary. The renting part is not really the issue. It's you, like, you know, in the scenario where someone's like buying this primary residence, 6 months later, like, oh no, I'm buying this neighborhood primary residence. Oh yeah, now I want to buy in this neighborhood primary residence. That's when the lender's like, listen, bro, this sounds a lot like you're buying some investments and trying to get the good terms that the primary residence affords you. Loops. I will try to help, even though I got to admit, I'm not a forbearance expert. I've looked at some of these things and I've talked with some clients to try to give like my honest feedback of what I would do if I was looking at some of these things. So here we go. Fannie Mae is pushing loan mod. I told them I saw the docs from the Fannie Mae website and partial claim or deferral is an option. If you don't want to do loan mod, yeah, tell them like you want to do the deferral. Are they pushing back and saying like, no, we're not going to do the deferral? I would imagine they have to, they have to, I wouldn't say have to, but most servicers are like trying to do things to help consumers stay in their house. Crayler Made. Great question. How does mortgage servicing typically work after a loan is sold? Basically, like all mortgage companies, and this is why I think it's almost comical when people are like, listen, we service all our loans. We don't sell servicing. Like 90+% of mortgage companies sell at least a part of, you know, their loans servicing to a third-party company. I know a lot of big lenders who sell, you know, they have exclusive agreements with a certain servicer, but for you, the consumer, it's just a new person collecting the payments. The terms are going to stay the same. They have to. The new servicer, you know, has to like go by the terms that were set with the initial loan. And so they're just collecting payments on the loan based on the terms that you initially signed for. Nothing should really change on your side. It sounds like you still like log into the same panel to pay the mortgage. So it's probably like a sub-servicer where like the same mortgage company might even own that servicing company. And it's like they sold it to them, but they own it as well. It's a sub-servicer, so they make it easier for the consumer. You just log into the same portal and pay the same payment. Have I heard horror stories of shitty servicers? Sure. But I wouldn't sweat it. You know, they've really got a pretty easy job. Collect payments and apply principal towards your balance. pay your taxes twice a year, pay the homeowner's insurance once a year if you're, homeowners and taxes are escrowed. Yeah, I think to avoid that, they've just there's sub-servicing agreements in place where like mortgage company sells to servicer, like, yeah, still log into this admin portal to pay your payment. We own that. I'm curious, what is the lender that has that cool, super slick panel? I know that UWM's is super cool. Mr. Cooper had a pretty cool one. I've had different servicers and different mortgages. Oh, Movement Mortgage. Yeah, I guess they've probably got a pretty slick one too. But yeah, it's cool. I think this is like pretty common practice now, where a lot of mortgage companies are realizing, like, make stuff cool, make it interactive. These folks will stick around, and maybe when the repeat business comes, they'll work with us. Good to see you, Kraler. Thanks for stopping by, my man. Deferral, do you have to pay it back at the end of the loan? My mortgage company is not trying to help, at least to me. You're not getting scammed. Yes, you have to pay it back, but like, they are being pressured. Pressured might not be the right word, but they should be trying to do whatever helps you. Whether that's defer and put it on the end of the loan, whether that's a loan modification. I don't necessarily think a loan modification is bad, but there should be multiple options for you to choose from. It shouldn't be like, hey, you got to do our loan mod, period, the end. And I would look at it, look at the loan modification. Maybe the terms are good. And clients that I have worked with that have reached out to me have shown me pretty sweet loan mod terms. So follow up with them, let them know that they're there to help, remind them of that. Maybe you got a bad person, you call back, you get a better person. Anyhow, been a long Monday. Happy New Year to everybody. I appreciate the heck out of everyone that joined. Reminder, next Monday, January 10th, Jimmy Hobson, VA expert. Bring all your VA questions. I'll put something up about you on YouTube. Maybe I'll have a running thing where I can do some questions where we started off with the first 5 or 10 questions we get in the YouTube community panel. I appreciate the heck out of you guys as always. As long as you guys keep showing up, I'm going to keep making these things. Thanks for joining. Yeah, that's that. Until next time, we going to see. Happy 2022 to you as well, Monty. Appreciate you. Thanks, Michelle. Appreciate you as well.